Okay, welcome to the SFM revision for November 2024 diet. In this revision would clearly be looking at the expectation for the exams. What are we expecting ICAN to look at? What are we expecting students at this point in time to use for the revision? Let's start with a quick recap on the key aspect of the syllabus. Now, as we know, ICAN has told us, as regards SFM, that the question 1 would always be from business analysis. So I'll divide the syllabus basically into 2 big groups: business analysis and others. Now, what do we expect from business analysis? There are 2 big topics in business analysis. In business analysis, you have investment appraisal, and you have business valuation. So if I was to be preparing for these exams, I would give 50% of my time to business analysis, and I'll give the remaining 50% of the time to others. Now, who are the guys that fall under investment appraisal? Now, investment appraisal, we're looking at the basic appraisal methods, where you have NPV, internal rate of return, modified internal rate of return, and maybe value at risk. Those are the first guys under investment appraisal. Now, the second guys under investment appraisal, we look at adjusted present value, APV. Adjusted present value, APV. And still under investment appraisal, you want to understand how real options works. What is real option? How does it work? Still under investment appraisal, you also want to understand international investment. International investment. And lastly, on this line of action, you also want to look at risk and uncertainty. I personally feel, if I was to be an examiner today, I would expect the question 1 to come from investment appraisal. Why? Because over the past 4 diets, we've been seeing questions from business valuation. So the expectation is from investment appraisal. My personal expectation. But remember, I'm not the examiner in this case. I'm just a guide in this particular issue. Okay, so don't forget, we're placing focus on business analysis on the assumption that if question 1, for instance, comes from investment appraisal and question 2 or 3 comes from business valuation, I'm covered with about 50 marks. Then if I take one of the theories, then I'm good to go with 2 questions to spare. So let's look at business valuation. Business valuation, as we know, basically covers the valuation methods. We could just decide to bring merger and acquisition here, and we could decide to bring corporate restructuring. So these 2 are just put here to block them up. So anyone preparing for these exams that closes this area, the chances of success are very, 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 very high. Very, very high. Now, what are the key things? Under others, I still break them again into 2. I call this high expectation. I call this low expectation. Now, why are we doing all this high and low expectation? It's because of students who basically at this time may not have time. And we are looking at what are the things I can actually skip and still have success in these exams. I will beg and plead with us not to play with anything on the business analysis. Read both the theories. At times I ask students, what are the advantages of payback period? Can you give 10 advantages of payback period? And you begin to realize that, whoa, payback period as easy as it is, the advantages are not at the tip of my finger. So I would advise that you don't play with any area here at all. Theory-wise, calculation-wise, make sure you block everything that could come out from this area so that the 50 marks expectation coming from this aspect, you've secured close to 30, 35. So that what you'll be looking from this side is just 15 marks, okay, and theories that may come in. Now, what are the high expectations from others? The first one here will be bond valuation. At times we throw it into business valuation, but let me just bring it here. Bond valuation. The second guy here will be source of finance. Source of finance. Okay. The third guy that comes to me here is CAPM and portfolio theory. CAPM and portfolio theory. And lastly, on this ball court will be capital structure theory. This is one guy that ICAN, the current examiner, has really not explored. Okay, capital structure theory. Now, who are those on the low expectation? Not that they don't come out, but like we said, if you want to begin to skip, the first guy there will be Forex, foreign exchange transactions. Under Forex, we have two big guys. Guy one is currency risk management. And guy two is interest rate risk management. Okay. Now, what's the second guy we want to bring here? Will be dividend policy. Dividend policy. And that dividend policy, looking at what are the factors that influence dividend policy, the types of dividend payments that we expect, would it be the payout ratios, calculation of dividend capacity itself. Then number three that will come in here will be forecasting. Okay, the issue of using ratio analysis to forecast likely what things will come. Now I want to put here number 5 as theories. Last night we had close to 2-3 theories in the exams. So theories will come under high expectation. Now what theories exactly? Let me break down the theories also. What theories are we looking at? Now I've broken down the theories into 3 aspects. Now theory 1 has to do with the stakeholder relationship, meaning we're looking at the objective of the business. Okay. We're looking at things like stakeholder theory, money laundering, and things within that range. That's the first aspect of the theory. The second aspect of the theory is also looking at the markets. We're looking at SEC, we're looking at National Stock Exchange, we're looking at corporate social responsibilities, and all the financial intermediary stories that come in there. And the last aspect of the theories, which I'll bring here now, are theories that have to do with Islamic finance, securitization, and other emerging theories. Okay? So indirectly, this is our syllabus. This is an overcap of what we expect that between now and Tuesday, you can test your strengths. Don't forget, what I've done is stage 1, break the syllabus into 2 big trends. Call the first trend business analysis. I'm not the one doing this, so I can say in question 1 will come from here. So knowing fully well what strategic financial management covers. If question 1 is going to come from here, it means that this aspect of the syllabus is entitled to a minimum of 2 questions. Means my strength here would secure 50 marks. You know, so that's why I said, if I'm struggling for 50 marks here, if at the worst case scenario I'm able to get 35, what that means is that I have a 15 marks here for 3 questions. See that the chances of success are really high. Okay, so if you're going to do a guest run on what you should not read, let it start from here, from the low guys, then maybe part of here, but have a good strength here. If you can score 35 or higher here, then this exam is a walkover for you. Okay, that's the first aspect of this revision, looking at SFM as a block cap. Now we're going to start hitting it one by each now, and looking at each area, what it's expected to cover. What are the key things I need to note as I go into the exams? What are those key things I need to remember as I enter the exam hall? I'm going to start with business valuation. And why am I starting with business valuation? Like we said, for the past 4 diets, for reasons best known to ICAN examiners, they've always been on business valuation, okay? But if we want to follow a trend analysis of good examining bodies, we expect that there should be a shift to investment appraisal. But like I said, and I'm saying again, we are just anchors to guide you. So I'm going to start quickly with an overview of business valuation. Then I'll move to investment appraisal. Then I'll move to the other ones, as many as our time can take, and expect that we get value for our time and money. Okay, so let's look at an overview of business valuation. I'm going to be using an exam approach, so I may not be going into irrelevant things that I feel are not relevant for the exam. Business valuation. Okay, like we know, business valuation generally simply means the process of determining the value of equity of a business. Let this be known, VE represents value of equity. So when you're valuing a business, the general concept, the general assumption by default is you are looking for the value of equity of that business. Now, one of the questions the examiner can ask is, why would a company want to value or determine their worth? Why would the company want to know the value of equity? What are the reasons? What are the likely reasons why I may want to value my business? So the first thing to note theory-wise is, what are the reasons for business valuation? Reason 1 could be for strategic planning. Reason 1 could be for strategic planning. What is strategic planning? A company would want to know where they are and where they need to be in line with what their long-term objective is. So because of that, they want to know their value. This helps them derive who are the value drivers. Are all the value drivers active? Are there value drivers that need to be worked upon or even changed? So number 1 reason is strategic planning, which is basically long-term planning. Number 2 could be for regulatory reasons. Number 2 could be for regulatory reasons. Now, regulatory reasons is saying either for government, for tax purposes, even for standards, FRS, or the IFRS also could insist that businesses value their assets for the purpose of declaration, for what purpose or the other. So it could be for regulatory reasons. Number 3 could be for the purpose of merger and acquisition. Okay? Either I want to combine with another business or to acquire another business. There's a need to know my value and to know the value of the target company. So that could be one of the reasons why one may want to value. Reason 4 could be when there's going to be a disposal of shares. Now, usually, if the government should invest in a company, or if venture capitalists should invest in a company, or any of the institutional investors. Remember, what's institutional investors? We said institutional investors are long-term investors who invest into an organization for the short-term purpose of growth and other things or encouragement. Okay, so if such companies want to dispose their shares, then automatically there will be a need to value that company to determine what the worth of the shares are. Okay, so these are some few reasons why companies may want to value. Taxation purposes are there, inheritance purposes are there, breakup purposes are there. Okay, so many reasons why companies may want to value. Now, another question the examiner can ask theoretically is trying to be practical. What are the things I would require? What are the things that will be required for business valuation? If you're going to do a valuation, The valuer, number one, should be a company that is registered with a license. And somebody will ask, what license to value? Okay. Now it's known that valuation goes beyond the practical or simple accounting issues. Valuation could involve valuing the estate. Valuation could involve valuing some thick-cut things. And that's why under valuation, we are guided by the International Valuation Standards, IVS. Valuation is guided by International Valuation Standards, which tells us what to guide. I can limit what we need to know as regards the standards, okay? But in core, what are the things, basic things that are required to do valuation? The valuer will ask you for one, your audited accounts. By standard, by default, they will say 3 to 5 years for an existing company, okay? So they want to see what has happened in the past. The audited account gives us an overview of what has actually happened in the past. What are the things that you're going to... Then they want to see what is happening presently. So they will ask you for your management account. The management account, maybe for the current year or for the current 6 months. Now the management account gives us an idea of some details of what's going on currently, what's happening presently as we speak, what's going on as we speak, okay? Now, they would also want to know where you are going. The third one will be a financial projection. A financial projection. This should likely tell us, based on backed up with realistic assumptions of where you are going to, okay? Then, there are some things we ask for in detail. Number 4, the valuer may begin to ask for things like an industry profile. That's a company profile. Showing us the industry you belong in. Showing us the ownership of the company. The spread of ownership of the company. We also want to know things about your contingent assets and liabilities. We want to know your market position. We may even be asking about your customer profile. Don't have to put that as number 5. We want to know your customer profile. We also want to know your liability profile, supplier's profile. Now, why are all these questions being asked? Now, for instance, a company may be so big, so large, okay, having so much high turnover, but that turnover may be influenced by just one customer or a few cabal of customers. So in our evaluation needs to capture the risk associated with having 90–80% of your income coming in from one source. What happens if that source is withdrawn? What happens if, as a result of diversion, as a result of breakup, that source of income leaves you? What is the impact? You know, remember I said when you are doing evaluation, you're doing a look at back, what you are doing. You're doing a look at what you are currently doing, and we're also taking a look at what you will likely do in the future. These 3 things are being brought together to achieve a good or a reliable valuation. So, for example, purpose, the examiner may just ask you, what would you require? Remember, it's always ending with other information that may be relevant. So that is practical, that is standard. If the examiner asks you, list as many as you can, list of assets, list of hidden assets, list of hidden liabilities. Okay, the next issue now is, how do we go about this valuation? How do we go about this valuation? How is valuation done? Now, according to ICAN, ICAN has limited our methods of valuation. How do we go about valuation? We call that the methods of valuation. I'm going to link this with a calculation because of our time. But like you know, what we're doing is just a quick cap on what you can look at before going to the exams and be sure that you close the routes. Now, under methods of valuation, the first method of valuation is the asset method. The first method of valuation is the asset method. Now, looking at the asset method, basically, the asset method assumes that businesses should be valued based on what we can see. So the asset method looks at what we call tangible assets. The big question now is, if this method looks at tangible assets, what happens to the intangible assets? That's the biggest disadvantage of this method. What happens to intangible assets? What happens to things like goodwill? What happens to things like patent? And the rest, okay? But The asset method is concerned with what we can see, basically. How do we calculate net asset for the purpose of this method? It calculates net asset as total asset less total liabilities. So your net asset is same as shareholders' fund. What comes to the shareholders? So it is total asset less total liabilities. Now, a lot of people ask, don't forget from the beginning, we said, when you are doing valuation, your focus is value of equity. And that's the reason why when you're doing net assets, you're removing all liabilities, both the long-term liabilities and the short-term liabilities should all be removed from the total asset to get what the value of equity is, which is the shareholders' fund. Okay, now when is the asset method suitable? The asset method is usually suitable when, remember, we're dealing with what you see. So the asset method is suitable, one, when you are dealing with a manufacturing organization. Remember, a manufacturing company, they deal a lot with big-term assets, very expensive, highly capital-intensive assets. So if you're valuing a manufacturing company, the assets will matter so much, even at times, cannot take more than even the cash flow. Okay. Two, if you are trying to value a business for the purpose of loan or as collateral for a business, then you need the asset method, because anybody who is going to give you a loan, anybody who is going to accept your business as collateral will be so much interested in the assets, things he can see if the business is failing and what their likely values will be. Okay. So, three, we also say if you want to determine the minimum value your company should be sold for or listed for, then the asset method will give you the lowest, because the worst that can happen to a business, if they cannot be listed, the worst that can happen is that they will sell all the assets in the business. Major issue when it comes to valuation. Now, still under the asset method, there are two ways the examiner will ask the question. Examiner will say, value the business. Way one, the examiner will ask it. He will break it down. Value the business based on net asset historic method. B, value the business based on net asset replacement method. And C, value the business based on net asset realizable value. Okay, this is the first way the examiner can ask the question. Okay, now let's explain this. What is net asset historic method? Net asset historic method is saying, give us the value of your business based on the balance sheet, which we call the statement of financial position. Don't adjust anything. Based on this, your audited account, if I look at your books, what is your value? So just go to the balance sheet, go to the statement of financial position, your total asset minus total liabilities. Whatever value you have there is what we refer to as your net asset historic. Okay, that is at status quo, no adjustment. Now, because a business is a going concern, if I want to know the value of the business using its assets based on going concern, it means I cannot use the balance sheet value of the assets. I need to get how much the assets will be bought if we are buying them today. So the net asset replacement method is looking at the business on the basis of going concern. So it's saying that if I want to value my assets now, I should value them at today's prices, not the prices I bought them when I bought them. Because if, for instance, I'm going to replace them, this is the cost at which I'm going to replace them. Okay, so the net asset replacement method values the assets based on the replacement values, which will be given to you by the examiner. So you don't really need to bug yourself as regards how to get the replacement values. It will be given to you by the examiner. So all you need to do is to do your total asset minus total liabilities, but this time using the replacement value. Net asset realizable value. We also realize that the business may be suffering challenges of corporate failure. Okay, they say a business may be struggling. Now, if a business is struggling and facing likely issues of corporate failure, whereby it has to get liquidated for whatever reason, then if you want to value the business, we are saying you can't value the business just with what the balance sheet is saying, because the balance sheet is saying what happened last Okay, so why not look at the value of the asset? Remember, when you want to sell things under distress, the prices are usually lower. People know you are under pressure to sell the assets, so the value of the assets are a bit lower because you are under pressure. So at this point, we are looking at a business that is being liquidated, facing challenges of liquidation, corporate failure. So these are the three strands of the net asset method. It could be based on balance sheet, it could be based on replacement, it could be based on realizable. Now let me sort one issue. If I say value a business based on net asset historic, it means everything is assumed based on the balance sheet. Okay? If I say value a business based on net asset replacement, it means that any asset that the examiner does not give me the replacement value is assumed that the replacement value is same as the balance sheet value. That's the assumption. So when you're doing net asset replacement, any asset or liability that does not have a replacement value, it is assumed by default, except otherwise stated, that the replacement value is the same as the balance sheet value. Same for realizable value. Okay, now when you are doing realizable value, there are three things you should expect out of the ordinary. What are those three things? One, you should expect to see things like bad debt. Okay. Two, you should expect to see things like theft, cash theft. And three, you may expect to see things like fire incidents. Okay, these three things are only peculiar to the net asset realizable value. You need to remove the bad debt from the receivables, the cash theft from your cash position, and the fire incident from your inventory, okay, to get what your realizable values are. Remember, any asset or liability that does not have a realizable value, it's assumed that the balance sheet value is the same as the realizable value. Now, this is the first way the examiner will ask the question, by asking you things one for each net asset. Now, the second way the examiner can ask you a question under the asset method, the examiner simply says, calculate the value of the business using the asset approach. He doesn't tell you whether balance sheet. He doesn't tell you replacement. He doesn't tell you realizable value. Now, when an examiner does that, what you do is every asset or liability will be treated based on the information on that asset. Let's come again. There are two ways net asset method can be tested. The first way is individually. We ask you for the different methods. The second way that it can be treated is that the examiner is silent. He simply says value the business based on net assets. So every asset or liability will be treated based on the additional information on that asset and liability. Anyone that doesn't have an additional information, you use the balance sheet value to determine the value of the business. Okay? So that's that for asset method. That's that for asset method. Now let's move to the next method. Let's move to the next method for valuation. Let's move to the net method for valuation. We're done with the asset method. Okay. We've looked at the likely advantages, situations where the asset method is good. We've looked at its challenges. Okay. Now let's move to the next method. Now the next method of valuation that we'll be looking at aside the asset method would be what we call the profit or the income method. The profit or the income method. Now the profit or the income method is a method of valuation that values a business based on the profit and available income. Now there are two basic methods, so it's using the profit. So any method of valuation that uses profit, it's called the profit or income method. Now what's the challenge? I like starting with challenges with the profit or income method. The first challenge is, what is profit? Profit at times could be unclear. Profit at times could be manipulated. Okay? So these are two challenges with valuing a business with profit method. It means that if I want my business value to be higher, all I need to do is to increase the profit and vice versa. Okay? So what are the two methods under the profit method? The first method we have here is the P ratio. We call it the price earnings ratio method. The second method we have here is the earnings yield. Okay? The first method is the price-earnings ratio. The second method is the earnings yield. When you say the price-earnings ratio, now how do you value a business using price-earnings ratio? Don't forget, price-earnings ratio is literally defined as the ratio of price to the earnings, which means price-earnings ratio is market price per share over the earnings per share. We refer to it as the confidence in which investors have on the shares of that company. Okay? It's the confidence which the investors have that the company's shares will appreciate over time. The higher the P ratio, the higher the confidence. Now, but when you are valuing a business using P ratio method, all you are doing, don't forget, whenever you are doing valuation, you are simply trying to calculate the market price per share. Okay? So market price per share, if I make it the subject formula, will be my PE ratio times EPS. So this is how you value a business using PE ratio. The market price per share of a company is PE ratio multiplied by the earnings per share. Okay? Now, looking at the earnings per share, looking at the PE ratio, what are the likely challenges you could face in the exam hall? Challenge 1. A company that is not listed has no PE ratio. So a company that is not listed on your stock exchange has no PE ratio. Okay? So how do I work with such a company? The examiner will give me a proxy company. But in reality, no two companies are the same, which means the proxy company is either larger or smaller than my company. By default, it's expected that a listed company is bigger or larger than an unlisted company. So what I advise students to do is whenever you are working with a proxy company, always state a disclaimer. What is a disclaimer? Always let the examiner know that you are aware that the P ratio you are using does not belong to the company you are valuing. And so there may be need for adjustment. Somebody may ask a question, how do I know whether a company is listed or not listed? Any company that is listed will have its own P ratio. So if I'm trying to value A PLC, for instance, an examiner says the P ratio of B and C PLC, who are in the same industry with A PLC, is that. This shows me that A PLC is not listed. Because if A PLC was listed, the examiner will not be giving me the P ratio of B and C PLC. He will give me the P ratio of A PLC. So when you are not giving the P ratio of the company you are valuing, that automatically implies that the company I'm valuing is not listed. To get the market price per share, it's supposed to be P ratio times EPS. Now, instead of the examiner to give me one proxy company, he gives me 3 proxy companies. What do? When you have more than one proxy company, to get your P ratio, you look for the average. So that means you add the P ratio of company 1, plus the P ratio of company 2, plus the P ratio of company 3, and divide it by 3 to get the P ratio that will be used for valuation. Okay? Those are 2 problems you could have with P ratio. Okay? Problem 1, the company is not listed. So the examiner gives you a proxy company. Whenever you're working with a proxy company, always state a disclaimer. Okay? Secondly, when you have more than 1, 2, 3 companies as proxy company, use the average P ratio for valuation purpose. Now let's look at EPS. How do we calculate EPS? EPS generally, like you know, is profit after tax over number of shares. That's the assumption. But remember, there could be preference dividend in the question. That will be a trap. Because if there's preference dividend, then it should be profit after tax less the preference dividend over number of shares in issue. So when you're calculating your EPS, it's always good, always essential that you check out if there's preference dividend in the question. P ratio is seen as one of the most reliable methods. Reasons being, number 1, we assume that it's going to be difficult to manipulate because it looks at the external, it looks at the internal. It's coming from a wide range of variables or considerations. So we believe that the P ratio, it's aside the challenge with the profit, that the P ratio is something we can rely on. telling us what the market wants as against the company's view. The second one under the income approach here is earnings yield. What's earnings yield talking about? Anything yield is looking at your return. Yield means return. So earnings yield is earnings return. Anything yield is comparing that thing with your market price. So if I say earnings yield, I am comparing my earnings, which is EPS, to the market price. Okay? So anything yield is return. I'm looking at my return based on what I've invested, which is the market price. Don't forget again, in valuation, what you are looking for is the market price. So all I need to do here, if I'm using earnings yield to value, is to make market price my subject formula. So I'll come here and say, market price per share is equal to EPS over earnings yield. So this is how you value using earnings yield. This is how you value using PE ratio. Very straightforward. Now the same factors that affect PE ratio affect earnings yield. What are those factors? One, earnings yield is only available for companies that are listed. And so when you are using a proxy company, we expect that you would state your disclaimer. Two, you could be given 2 or 3 proxy companies. So if you have more than 1 proxy company, when doing earnings yield, you use the average. Okay? That takes care of the methods that fall under the profit or income method. We've looked at the asset method. We've looked at the profit or income method. Now let's look at the cash flow method. And then round up with the list method. Okay? Why are we concentrating on this? Like we said, if they go there, then fine. Now quickly, let's look at the third method under valuation, which is the cash flow method. Like the name says, the cash flow method refers to any method that makes use of cash in valuation. Any method that makes use of cash will be grouped under the cash flow method. Now, cash flow method is very objective. Irrespective of how you look at the cash, everybody looks at cash the same way. For instance, if I ask you what's your cash value, all you need to do is to check your bank statement to say, oh, based on my bank statement, my cash is this amount. You know, that's one of the things that makes the cash flow method very objective and reliable. Now, what are the methods that fall under the cash flow method? Now, the first one we'll take is the dividend yield. Now, we call this a cash flow method simply because dividend is usually assumed to be paid in cash. Some other school of thought may argue that the dividend should be under income method. Okay, but we classified it under cash flow because we assume that the dividend will be paid in cash. Okay, so the dividend yield method, don't forget again, anything yield is return. Okay, you're trying to look at your return when compared to the market price. So dividend yield is calculated as DPS, dividend per share, over market price per share. Don't forget, when you are valuing, what you are looking for is market price. So if I make market price my subject formula, it will be dividend per share over dividend yield. So this is how I value under dividend yield. So valuation under dividend yield will be on this basis. Now the next method, or the next sub-tranche that comes under cash flow method, will be your dividend valuation model. If you recall your cost of equity, we talked about dividend valuation model, DVM. This is a fundamental theory that values businesses based on their future cash flows. Now, dividend valuation model, if you look back at cost of equity says that DO 1 plus G all over the market price per share plus G. Sure, we're all conversant with this formula for cost of equity. But here we're not calculating cost of equity. We are trying to value the business. Whenever you are valuing a business, you're trying to get the market price per share. So what I'm trying to do here now is simply make the market price per share my subject formula. Okay, so as mathematicians that you are, the market price per share, if it's going to be the subject formula, the numerator remains. The G comes here. So this is how you value a business using dividend valuation model. This is simply the formula extracted from your cost of equity formula, which was also going to be given to you on your formula sheet. So all I've done is make my market price per share the subject formula. Okay? Take note. DO represents the dividend now. Don't forget about that. Then G is your growth rate. Still remember that this is your G. The examiner may ask you to calculate the G using Gordon or using dividend growth model. So that's the worst that can happen in dividend valuation model. The growth rate may not be given to you. So you may need to calculate it using Gordon or using the dividend growth model. Thirdly, is what we call the discounted cash flow method, DCF. Now this is simply a method that looks at the present value of your future cash flows. So the same thing you do when doing an MPV question is what you do under this method. The only difference is the fact that there would be no initial outlay. So we're looking at all your inflows to determine what your value will be under discounted cash flow method. So it's normal stuff you do under your MPV, which we'll look at under investment appraisal. But the difference is that there will be no initial outlay. Lastly, under cash flow method is the big boy. And who is the big boy? Free cash flow. Okay? Just as it is difficult in today's business world to do without CAPIM, to do without beta factor, that's how it's also becomes so difficult to do valuation without free cash flow. It's difficult to do valuation without free cash flow. What's free cash flow? The name free cash flow simply means cash that is residual, cash that is left, the balance cash after you have done all necessary expenditures. Okay? So after a company has done all what we call the relevant expenditures, the cash that is left to settle the owners of the fund is what we refer to as free cash flow. Okay? Now, there are two types of free cash flow. But before we go to the types of free cash flow, for theory's sake, the examiner may ask you, when is it appropriate to use free cash flow? Now, it's appropriate to use free cash flow method when, one, the company does not pay dividend. If an examiner says the company pays no dividend, that implication implies that your best method would be to go for free cash flow. Two, when a company pays a dividend that does not match, we call it an insufficient dividend. When a company pays a dividend that does not match its dividend capacity, we refer to that as insufficient dividend. Okay? In that case, you may have to turn to free cash flow. When a company pays a dividend that is not sufficient or does not match its dividend capacity. Now, when we are looking for an objective method of valuation, then the best method to turn to may be your free cash flow. Objectivity is saying that if all of us use this method, we'll get the same result. Okay? So if you're looking for such a method, free cash flow method will be your best bet. Now, what are the types of free cash flow method we have? There are two free cash flows, or two subsets of free cash flow. Let me call it types. Now we have what we call free cash flow to the firm, and we have what we call free cash flow to equity. Okay? The FCFF here represents free cash flow to the firm, to the whole company. And the FCFE here represents free cash flow to equity. Free cash flow to equity. Now what's free cash flow to the firm? Free cash flow to the firm refers to cash flow that belongs to both equity and debt holders. So if the cash you want left is a cash that should be sufficient to satisfy the equity holders who are the shareholders and those who have given you debt, the loan holders, then you're talking about free cash flow to the firm. Now, but if you're only interested in equity holders, then you're talking about free cash flow to equity. So free cash flow to equity belongs to only equity holders. So free cash flow to equity belongs to only equity holders. Okay. Now, if I'm valuing a business, don't forget again, valuing a business means I'm looking for the value of equity. If I'm valuing a business using free cash flow to the firm, what do? Simply, the value of equity will be the free cash flow to the firm discounted, I'm assuming there's no goods, using your WACC. Then I take away the value of debt. Let's look at this very well. When you are valuing a business using free cash flow to the firm, because free cash flow to the firm belongs to both equity and debt holders. When you discount it using WACC, the next thing to do is to remove the value of debt so that you can arrive at the value of equity. So maybe I should put this in brackets. So if you are doing free cash flow to the firm and you are looking for the value of equity, you will need to discount the free cash flow to firm using WACC and then deduct the value of debt. So that means whenever I'm working with free cash flow to firm, my discount factor must be WACC. If there's growth, then doesn't change anything. It will be free cash flow to firm into bracket 1 plus G all over WACC minus G minus value of debt. That's all. That's all that changes. So the key thing is your free cash flow to firm, if you are looking for value of equity, you must remove the value of debt. Because what the free cash flow to firm gives to you is the whole value of the organization, which we call VO. Remember, we said in capital structure that the value of an organization is value of equity plus value of debt. So which means value of equity is equal to VO minus VD, which is what we are doing here. So, using free cash flow to firm to value a business, this is what is going to happen. Free cash flow to firm is free cash flow that belongs to both equity and debt holders. Now, what if I'm only interested in equity holders? So that means I'm talking about free cash flow to equity. Now, free cash flow to equity is also called dividend capacity. So if an examiner wants to try you, rather than calling it free cash flow to equity, he may ask you to calculate the dividend capacity of the organization. So the dividend capacity of the organization is the cash flow left aside for equity holders. Now, simply, the value of equity will be equal to free cash flow to equity discounted using the cost of equity. So which means if I'm only interested in what belongs to equity holders, my discount factor will be cost of equity. I don't need to remove the value of debt, because the free cash flow to equity belongs only to equity holders. Now, this is the difference between free cash flow to firm and the free cash flow to equity. Now, let's now see how do we calculate free cash flow to firm and free cash flow to equity. How do we calculate them, basically? Okay, so let's look at calculation of free cash flow to firm and free cash flow to equity. Now, don't forget that every valuation is assumed to infinity except otherwise stated. Every valuation you do, you assume that that company is going to exist to infinity except otherwise stated. Get back to that. Now, if you are calculating free cash flow to firm, advisable, start with your operating profit, which is PBIT. Usually given your PBIT. Now you take away tax. Now this tax is tax rate times PBIT. So you settle the government their tax. Now because we are dealing with cash flow, you will check if there's anything that does not involve cash. So I will use the word adjust for non-cash items. Now, why am I using the word adjust? It could be an income, it could be an expense. If it's an expense, like depreciation, you will add back. If it's an expense, like a loss on disposal, you will add back. What if it's a profit on disposal, an income, you will less? Okay, usually for ICAN it's been depreciation all along. But we need to be ready for worst case scenario. So first thing first, the PBIT, take away tax, adjust for non-cash. What do you do next? You adjust for investment in working capital. Now when you are adjusting for investment in working capital, there are two things to note. When you are adjusting for investment in working capital, there are two things to note. Number one, cash and cash equivalent should be ignored. Because we are dealing with cash flow, bringing in cash again is like double counting or waste of time. So number one, when you are adjusting for investment in working capital, cash and cash equivalent should be ignored. Number two, when you are adjusting for investment in working capital, another thing to note is how to treat your short-term debt or short-term loan. Short-term loans are briefly defined as loans that we expect to be paid back within 1 year. Okay? Now, but when you're doing your free cash flow, the short-term loan does not come under working capital. It is taken to debt. Okay? When we're treating debt, it's treated as a financing cost and not an operational cost. So it's taken to debt and not working capital. So two things when you're preparing your free cash flow to firm or free cash flow to equity. Number one, ignore cash and cash equivalents. Number two, your short-term loan should be treated as debt and not working capital. Okay, so how do I do my investment in working capital? Two approaches. You can actually get your current asset less current liabilities and do that, or you can take them one by each. When there's an increase in your non-current asset, that's an outflow. When there is a decrease in your current asset, that's an inflow. When there's an increase in your current liability, that's an inflow. When there's a decrease in your current liability, that's an outflow. Now let's analyze this. What are we saying here? What we are saying here is, if you have more inventory, it means you went to purchase. You paid money. If you have less inventory, it's assumed you sold, inflow. If you are owing people, it means the money you are supposed to pay them, you kept it back, inflow. But if your liabilities reduce, it means you went to pay the people you are owing, outflow. So anytime there's an increase in current assets, it will be an outflow, and vice versa for a decrease in current assets. Now this is one way to do it. Another way you could treat this is, some people prefer to do it under workings. You come under your workings, you bring in the years consigned, year 0, year 1, year 2, year 3. You add all your current assets, you add them. And you take away all the current liabilities. So you have current assets, take away the current liabilities. Take away the current liabilities. So that what you are working with is your working capital. So rather than moving line by line, taking current assets, no, you just net up the whole thing and get your working capital. Now, if you're working with this approach, anytime there's an increase in your working capital, is an outflow. Anytime there's an increase in your working capital, is an outflow. Anytime there's a decrease in your working capital, that will be an inflow. So any of the two approaches, depending on how you want to show the skill. Okay? So take notes before we leave the area of working capital. That when you're working investment in working capital, two things to note. Note one, ignore cash and cash equivalent. Note two is the issue of short-term loan. That the short-term loan should be treated. You shouldn't consider short-term loan when dealing with your working capital. It should be taken to non-current liability or debt. Now the last one is investment in non-current assets. investment in non-current assets. Now, if you have an increase in your non-current asset, what does that mean? It means you acquired, so there's an outflow. If you have a decrease in your non-current asset, what does that mean? It means you dispose, that's an inflow. So this is acquisition, this is disposal. Once you do this, you get your free cash flow to the firm. So it means, for simplicity's sake, how do I calculate my free cash flow to the firm? PBIT, pay the government, adjust for non-cash items, invest in working capital, invest in non-current assets. I get my free cash flow to the firm. So maximum, you're doing 1, 2, 3, and 4. Just 4 adjustments. Start with your profit before interest and tax, pay the government their tax, adjust for anything that is non-cash, invest in your working capital, invest in your non-current assets, and that gives you a free cash flow to firm. So no matter how tough, how complicated a free cash flow question is, if I were in the exam hall, the first thing I would do, I always tell students to make the examiners feel that it was time. So even if you don't know the question, don't let it become so obvious, that you don't know the question. It's a question of free cash flow, but it's very complicated. What do I do? You put the format first, as if you know it. So you do PBIT. You say less tax. Add back non-cash expense. Plus or minus investment in working capital. Plus or minus investment in non-current assets. So you do something like this, you put the company name, if it's for 1 year, and you say free cash flow for whatever company. So when you do this, and you begin to do all these other ones as workings, what happens is, if you are unable to complete the question, you send a message to the examiner that if only they had given you 5 more minutes, just 5 more minutes, you would have been able to finish this. So make sure you have put the template so complete, and you begin to take all this as workings. So the examiner gets boggled up into the fact that if only they gave this person time, this person knows what he's doing. So no matter how complicated the free cash flow question is, the template remains the same. The only challenges will be the different workings that will come into it. So once you see you don't know the question, there's no need showing too much skills. Put the template down and begin to disguise the others as workings. But like I said, there are only 4 calculations you need to do to get your free cash flow to the firm. Only 4 calculations. 1 is the tax. 2 is the non-cash expense. 3 is the investment in working capital. And 4 is the investment in non-current assets. Okay, quickly now, before we move to free cash flow to equity, let me talk a little on non-current assets. Non-current assets. Now, in non-current asset, there are 2 scenarios you should expect. 2 scenarios you should expect. Scenario 1 in non-current asset is when you are giving cost of the asset. This is what I mean. Examiner says year 2021, year 2022. He says cost of the asset is 500, 600. He says accumulated depreciation is 50, is 100. Then he says net book value is 450, is 500. And it says calculate the investment in non-current assets. Anytime you are giving cost, the investment in non-current assets is the difference between the cost of last year and the cost of the current year. Anytime you are giving cost, you ignore the accumulated depreciation, you ignore the net book value, just calculate this. So in this question, my investment in non-current assets, there's an increase of 100. I'll just come here and say 100. That's all. Because I'm giving cost. Okay? Now, what if the cost was not given? What if all I was given in the question is the net book value and the depreciation for the year? Okay? What if all I was given is the net book value? So anytime you are giving just the net book value, okay? Anytime you are giving just the net book value, how do you get your investment in non-current assets? It will be your closing balance, which in this case is 500, plus the depreciation for the year, which in this case is 50, less the opening balance, which in this case is 450. You see that? Two things. What am I giving? If you are giving cost, that's a straightforward question. Just get the difference in your cost. If it's an increase, like we said, it's an acquisition, it's outflow. If it's a decrease, it's a disposal. Now, but if you are giving net book value, then to get your investment will be closing balance, that's the balance for the current year, plus the depreciation for the year, less the opening balance. And that gives you your investment. And that gives you your investment. Lastly, to round up with free cash flow to firm. What if the examiner does not give me profit before interest and tax? Remember, we've assumed here that we should start with profit before interest and tax. What if the examiner does not give me profit before interest and tax? What do I do? Now, when you're not giving profit before interest and tax, the examiner will give you profit after tax. So all you need to do, let's call this 3, adjustment for profit. So in that case, you just do profit after tax and you add back the interest, net tax. So let's use a scenario. Let's assume PBIT is 400. Let's assume interest is 100. That gives us a PBT of 300. Let's assume tax is 20%. That gives us a tax of 60. So that gives us a profit after tax of 240. So what we are saying is, when I'm solving for a free cash flow, I have two approaches I can use to adjust for the first two items. I can use PBIT. I'll come here and say 400 less the tax. The tax rate is 20%, which is 80. 20% of 400 is 80. So that means my adjusted profit here is 320 using this approach. Where it says, what if I was not given PBIT? I can now say PAT, which is 240. Add back my interest, net tax. My interest is 100. Net tax of 20% is 80. So that's what we're saying. That you can either do profit before interest and tax, less tax, or profit after tax, add back the interest, net tax. Okay, so those are the likely issues we expect to see on free cash flow to firm. Those are the likely issues we expect to see on free cash flow to firm. So when dealing with free cash flow to firm, we expect worst case scenario. These are the things you should watch out for. Okay, these are the things you should watch out for. Now let's quickly look at free cash flow to equity. Let's quickly look at free cash flow to equity. Now, just a slight difference. Everything we've done in free cash flow to firm, we will still do in free cash flow to equity. Just a little difference. And that's just what I want you to pick from what we want to do on free cash flow to equity. That little difference. That little difference. Because free cash flow, like I said, has become like CAPM. Very, very needed when valuation comes in. So in free cash flow to equity, you start again with your PAT. Take notes. When you're doing free cash flow to firm, you want to start all the way from PBIT. But if you're doing free cash flow to equity, just start with your PAT. Add back depreciation. That's the same thing as saying adjust for non-cash expense. Okay? Do your investment in working capital. Do your investment in non-current assets. And lastly, bring in debt. So this is the new introduction. And that gives you your free cash flow to equity. Now what comes in debt? There could be an increase in debt. If there's an increase in debt, that means you borrowed more money. So that's an inflow. If there's a decrease in debt, which means you paid back the money you are owing, so this is your calculation for free cash flow to equity. This is your calculation for free cash flow to equity. Start with profit after tax rather than PBIT. Add your depreciation. Adjust investment in working capital. The same thing we did under free cash flow to equity. Adjust investment in non-current assets. And then adjust for your debt. And that gives you free cash flow to equity. So that's all about. Now, what's the relationship between two? If I bring my free cash flow to firm, for instance, if I take away interest, if I add back the interest net tax, and I adjust for debt, the same thing I've done here, we expect that it should give me free cash flow to equity. That shows that the difference between the free cash flow to firm and the free cash flow to equity is what belongs to debt holders. The difference between free cash flow to firm and free cash flow to equity is what belongs to debt holders. Okay, so let's quickly look at the last methods under valuation. I'm not going to waste time with that, but my fear with those methods is they've been tested last. Like EVA was tested 2015, SVA was tested 2020, and market value added has not even been tested. It was tested together with EVA far back 2015. Now the reason for this is that ICAN has been testing it under performance management. You know, but anytime they flash it in the final level, people struggle with it because it's not come out. You don't have a lot of past questions. For instance, in the whole of the past questions, you have only one question on EVA, only one question on market value added, and only one question on shareholder value analysis. Okay, so you don't have sufficient past questions to look at it. So that entails that we need to just talk about it in case this diet is one of those diets when ICAN decides to flash them again. There's really not much questions on it, but it's something you need to note as part of your syllabus that has to do with valuation. Okay, so this value-based method, there are three methods basically that fall under the value-based method. The first one is known as shareholders value analysis, SVA. Shareholders value analysis. Okay, what shareholders value analysis is saying? It's simply saying value a business based on the value drivers. And it helps us list out 7 value drivers. Value driver 1 that was listed is the growth in sales, which we call sales growth. Value driver 2 is your cost of capital. Value driver 3 is your profit margin. Value driver 4 is our tax rate or tax in general. Value driver 5 is investment in working capital. And value driver 6 is investment in non-current assets. And value driver 7 is our growth period. So in case you are asked to discuss the value drivers in shareholders value analysis, these are the 7 value drivers in shareholders value analysis. How do we calculate SVA or use SVA to value a company? You get the PV of the operating assets. You get the PV of the operating assets. Which assets are referred to as operating assets? Operating assets, we're talking about non-current assets, and we're talking about working capital. This is what we call operating assets. Okay? So it's PV of operating assets plus the PV of non-operating assets. Non-operating assets we're referring to as cash and any short-term investment. Okay, they come under non-operating assets. And then lastly, you remove your market value of debt. So this is how you calculate shareholders' value analysis. It uses the free cash flow approach, so you won't have a problem. Everything we've discussed under the free cash flow approach is what the shareholders' value analysis uses. Okay? Key thing, remember the drivers and remember the calculation. The calculation is PV of operating assets plus PV of non-operating assets less the market value of debt. Now let's move to the next method ever, economic value added. Economic value added. Ever. Now, ever generally believes that accountants are very manipulative. And if you don't put measures in place, that accountants would defraud us. Let me use that English. So ever is trying to say anything you want to give us for valuation must be items or variables that can be trusted. So in doing that, ever says, when you are calculating ever, which is another name for economic residual income, ever is NOPAT, net operating profit after tax, minus WACC, times, let me just call this capital employed, even though we call it economic capital employed. Okay? So ever is NOPAT minus WACC times economic capital employed. This is how ever is calculated. Now for NOPAT, net operating profit after tax, you call that your working one. How do we adjust for NOPAT? The same thing. I like starting with operating profit, but remember I told you you can also start with profit after tax. Either way you arrive at the same result. So I start with my operating profit, which is the same as earnings before. So your operating profit is same as PBIT. So I start with my operating profit as usual. I take away the tax. In this case, the tax you're taking away is the tax paid in cash. Somebody will say, what do you mean by tax paid in cash? In some scenario, the examiner will give you tax in your income statement. Let's assume 40. He will now come in additional information and say, for that year, the company has paid 35 million as tax, but the actual tax they were supposed to pay is 40. When you have such a question in ever says recognize the tax that was paid in cash, and the other should be added back or readjusted. Okay? So the tax we're interested in is the tax paid in cash. So when I remove the tax paid in cash, I remove the tax shield. Tax shield is interest times tax rate. Please remember, I'm starting with PBIT. Okay? So the first two things you take out is tax and tax shield. Why? These two items would usually not be in additional information. The tax and the tax shield will not be in additional information. They will be in your income statement. That you should settle first. Once you settle those two items, then you can move to the next. Now, what are the next items? There are three big items. The first one is depreciation. Ever says, I don't believe in accounting depreciation. So if ever does not believe in anything expense ever does not believe in, you add it back. You are correcting errors and correction. So you are supposed to add back accounting depreciation because ever does not allow it. Okay? Now ever says in place of accounting depreciation, can we look at the impairment of the assets? Okay? So in place of accounting depreciation, can we look at the economic depreciation, the actual decrease in the market value of the asset? So ever says add back, correct it, your accounting depreciation, but less economic depreciation. So in place of accounting depreciation, we remove economic depreciation. That settles depreciation. Okay? The second thing ever talks about is provision. Anything that doesn't involve cash, ever doesn't like it, is provision. Now, under provision, what is ever saying? EVA is saying, look, whenever there's an increase in provision, it doesn't involve cash, and you have treated it as an expense, correct it. So when there's an increase in provision, you add back the increase in provision. Okay? But if there's a decrease in provision, you less it. Because the decrease in provision was treated like a savings in cost. That's how you deal with provisions under EVA. Okay, we've talked about depreciation. We talked about provision. Now let's go to the third one, long-term expenses. EVA does not understand that language. What do you mean by long-term expenses? As far as we know accounting-wise, we should amortize any cost we have. So if, for instance, a research and development cost that is supposed to last for 5 years, based on IFRS, you have expensed it in a particular year, EVA will say, no, 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 no. If this cost is meant to be for 5 years, you cannot expense it in 1 year. So EVA will say, correct it. So you add back any long-term expenses. Okay, add back any long-term expenses. Expenses that fall within this range are things like marketing, advert, research and development. This kind of costs fall under long-term expenses. EVA says add them back. Now what should you deduct? Deduct only the one for the year, so less the expense for the year. So if, for instance, 5 million was paid as research and development costs for the next 5 years, and I've expensed it, EVA is saying add back that 5 million and deduct only 1 million for this year. That's how you treat this. Now, what are the other expenses that EVA will point out? There's what we call other non-cash expenses. EVA has grouped every other expense we can't think of as other non-cash expenses. You need to add it back. Because EVA, so this is 1, okay, this is 2, this is 3, and this is your 4th adjustment. So these are the 4 big adjustments you will always see in EVA. The biggest challenge people face is actually the issue of provision. Now, what are the challenges they face as regards provision? Challenge 1. Any provision you see in your operating cost is an increase in provision. Decrease in provision will not appear under operating cost. So any provision you see in operating cost is an increase in provision. Okay? That's one of the challenges you face in provision. 2, how do I know when it's an increase or a decrease in provision? So those are the key things. Aside that, this has taken care of our EVA, and these are no part. Please take note. Your no part is an adjustment for current items. Your no part should be adjusted based on the current year's figure. Okay? So this is how you adjust for no part. So no matter how complex an EVA question is, when you're solving for your no part, start with your profit, take away tax issues, treat depreciation, treat provision, deal with any long-term expense, and then take care of other non-cash expense. And you are good with your EVA question. You are good. We already know how to calculate our WACC. Just 10 minutes. Okay. It's just 10 minutes. There's nothing we can talk in PM. So thank you.